Let's get across the market open now. Chris Weston joining us from Pepperstone. Chris, welcome back to you. Let's take a more global picture at the moment, particularly given what we've seen with the US Treasury and that intervention there. It's leading to the debasement trade again. What are you seeing?
Well, I think it started a month ago or so when we saw central banks stepping up and accumulating gold again and ramping it up as part of their reserves, and that was into the sort of 4,000 level, and that set a really nice platform up for a move higher. Then I think what we've seen really is these debasement proxies have really come back into vogue. We saw that last year between September and December, and then going into the new year, there was sort of a ripping trend in crypto and Bitcoin, and gold. And I think that was as people sort of questioning the US dollar situation and US independence and various factors. But I think we're back in that situation now where the US fiscal position has clearly deteriorated in the July deficit numbers. We've seen the deficit pushing above 6% of GDP at the moment, and that's not just a deterioration that's been caused by having to pay back tariffs. But the spending has started ramping up again, and people have been focusing very much on the interest expenses as part of that. And now I think what we saw last week has really developed, and that was a big catalyst and admittance from from the US Treasury Department and the US government that the fiscal position is pretty precarious, and that they've come out and doubled the size of the buybacks at the long end, not because of liquidity purposes, but because they really want to cap long in 10 and 30-year Treasury yields, because ultimately the market sets those rates, and the market sees that as a symbol of and how they see the US fiscal position. The short end is more controlled by the Fed, but the long end is term premium and issuance and inflation expectations, and that gives you a 30-year yield essentially. But they wanted to cap it at 5.30, and I think the new development overnight is not only that the US government are now going to limit dollar access effectively to those what they coin money laundering with Iran, which is a US dollar positive and also positive for gold. But they're actually now talking about how they're going to pay for those buybacks. Everyone thought they were going to be issuing more T-bills and short-term debt, and therefore it's not QE because no new money's being put into the system. But now they're talking about actually using the Treasury General Account, which is the Fed's checking account or the Treasury Department checking account with the Fed, to actually fund that long-end purchases, which in theory is actually very positive for gold because it may increase reserves in the system. So I think that's an interesting development. But they're very, very sensitive to that long end, and the market sees that as a sign that the fiscal position is pretty much unsustainable over the longer term. And buy gold, buy Bitcoin, probably sell dollars to an extent.
Chris, do you get the sense the market is likely to test Scott Bessent at the long end?
I think there's a very good chance. I think the other sort of second question then is if yields were to go above 5.30 and continue to move higher, would that be a negative for gold and these debasements in the idea that long end yields is generally bad, rising yield is generally bad for gold because you get a better return potentially in the fixed income market, and gold has no yield, so it looks relatively less attractive. I don't think that'll be the case. I think what you'll see is a situation where if the market tests it, they'll probably say, we want a response from Scott Bessent. We want to see them increase, say that they're going to increase the size again. Again, that then feeds into the TGA drawdown, increased liquidity. And effectively, I think, that would be a sign that they are really prepared to do more. And I think, that would be a positive for the gold situation. So, I think if you're long gold at the moment, you probably want the bond vigilantes to come out and test the long end of curve and putting long end rates up. But I think that will need other factors to play out. It's not just going to be, come on, let's go and short duration and and test Scott Bessent and co, because we know he's pretty good for it. But I think it's going to need a more hawkish situation from Kevin Walsh later this week in Jackson Hole. I think he'd need to come out and surprise the market a little bit. Some of the data would need to improve to the sense that we start getting high yields on that as well. So I think market forces and the Fed need to come to the party. It's not just going to be the bond vigilantes that come out and push that. You probably need higher crude prices as well to push up inflation expectations. But I think if you're long gold, you probably want the market to test out those long end rates and get Scott Bessent to say he's good for more of the buybacks there.
And Chris, as you mentioned, the short end then obviously likely to be influenced potentially of what we would hear from Kevin Walsh at the end of the week. Mind you, he hasn't really given the market anything to go on, has he?
Well, he has. You're right. pricing risk around these sort of situations when you've got a man saying, we want to give you less, it becomes a little bit more cumbersome. We want definition. We want to be able to have conviction in being able to price an outcome. What's the sort of expected movement? Where's the risk in movement around a certain event? And when you can't price that, you typically get higher volatility. Your liquidity can pull out because people don't want to be exposed to those sort of events because you have no edge. And he's been purposely vague around these sort of situations. I think at the most we're trying to ask ourselves, will he give something that sort of backs up what Scott Bessent has said to try and calm the market, or will he continue to note that the inflation is significantly higher than where the Fed need it to be for some time, and maintain a sort of a hawkish gesture and push the dollar up, push front end rates up, and sort of justify the idea that we could still see a rate hike by the end of the year. So, I think there's a million different scenarios we're playing through. Volatility is priced pretty low for this meeting, though, or for his speech. So, I think people can see it different ways. The market will do what it wants to do, but in theory, I think he'll be continue to be quite vague and nonchalant.
And Chris, on the equities front, key event this week, of course, will be Nvidia. In fact, we saw it come off about 3% overnight. How are investors positioning themselves, do you feel?
Well, I think people are sort of running it a bit more flat, a bit more neutral than we have done over previous times. I mean, it's done okay going into earnings, but I think if you look at the options market, the market's implying a move up or down on the day of earnings. For Thursday's cash session of 4.6%, which actually is a massive move for a company of its magnitude, biggest market cap in the world. But it's actually the lowest levels of implied movement by the options pricing on the day of earnings that I think we've seen in years. And I think also the relationship with other stocks in the aftermarket and reporting has broken down quite sharply over recent quarters. But I think the problem with Nvidia is that they can come out and smash reported earnings, revenue and margins. They can guide to higher than even what the buy side's looking for, and it often doesn't matter. The last 4 reports, they've beaten expectations by some way, and the stock's fallen. So there's always more to it. We're seeing that server prices are going up on its key customers. Will they talk about that? We know they're going to be talking about demand for Rubin and Blackwell off the charts, and they've got supply issues still coming through, but will that matter? So, I think there's a lot to it. The market's been less sensitive to the earnings and the guidance, and there's been other factors that need to play in through that. So, I think it's going to be an interesting one. But the hyperscaler build-up's obviously real. They're talking about a potential massive stake coming through in Perplexity as well. They talk about that. All I say now is that the market is expecting movement, but it's the lowest amount of movement or the smallest degree of movement on earnings that we've seen in many years. So I think that's an interesting dynamic in itself.
And Chris, how are we set up for the Asian session?
Flat. It's as I said, a lot to play through this week. We didn't really get too much in the crude move last night from Bessent's. Talking what's happening with sanctions around those buying crude off Iran. So energy's not doing too much. But SPI futures are up very modestly indeed. Asia's going to open on a fairly flat note. There's been a lot of life in some of the AI stocks around Hong Kong, and they're still worth looking at. But all intents and purposes, pretty flat. We're looking at RBA minutes and bits and pieces. But we'll see how the session pans out. See if anyone is prepared to put new money to work on the open. But flat on the open so far.